The first time most people hear the number, it doesn't sound scary. $500,000. It sounds normal now, almost modest. The kind of price you half expect to see on a starter home listing with laminate countertops and a suspiciously wide-angle photo. But here's the uncomfortable truth most people don't say out loud. In 2026, a $500,000 house is not a middle-class purchase. It's a filter. And the question is this house expensive? The real question is, who actually makes it through that filter? Because math doesn't care how hard you work, how responsible you've been, or how badly you want a backyard. It only cares about numbers. So today, let's pull this apart calmly, slowly, and honestly. Not to scare you. Not to hype you. Just to see who can really afford a $500K house in 2026, and who can't, no matter what the headlines say. And by the end, you might realize the housing market isn't broken the way most people think. It's working exactly as designed. Now let's set the stage. A decade ago, $500,000 bought you something impressive in most of the country. In 2026, it buys you access. Access to a mortgage approval, access to a neighborhood, access to stability if you qualify. Why does this matter right now? Because wages didn't rise the way home prices did. Because interest rates didn't fall back to where people hoped. And because inflation quietly rewrote what affordable means without asking permission. According to economists like Robert Shiller, yes, the Case-Shiller Index Shiller housing affordability doesn't collapse all at once. It erodes, slowly, invisibly, until one day the math stops working for most people. And in 2026, that erosion is fully visible. So let's talk about how the system actually works. Not vibes. Not Zillow dreams. Just mechanics. If you're buying a $500,000 home, you're not borrowing $500,000. Best case scenario, you put 20% down. That's $100,000 in cash, not stocks, not crypto, cash. Most buyers don't have that. So let's say you put 10% down, that's still $50,000 upfront. Your mortgage is now $450,000. Now we get to the number that quietly controls everything. The interest rate. In 2026, most housing forecasts from Freddie Mac, the Mortgage Bankers Association, and even cautious voices at the Fed expect mortgage rates to stabilize, not crash. Think mid-6% range, maybe high 5s if things break perfectly, but not 3%, those years are gone. So let's be conservative. A $450,000 mortgage at 6.25% over 30 years. Your principal and interest payment alone. Roughly $2,770 a month. And we're just getting started. Add property taxes. In many states, that's another $400 to $700 a month. Add homeowners insurance, add maintenance, add HOA if you're unlucky. Suddenly, that $500K house costs about $3,400 to $3,800 every single month. Before groceries. Before childcare. Before student loans. Before life. Now here where the filter tightens. Banks don't care if you can make the payment once or twice. They care about ratios. Specifically debt-to-income ratio. Most lenders want your total monthly debt, mortgage, car, credit cards, student loans, under 43% of your gross income. Some allow less, very few allow more. So let's reverse the math. If your housing costs are $3,600 a month, lenders generally want that to be no more than about 28 to 30% of your gross income. That means you need to make roughly $12,000 a month before taxes. That's $144,000 a year. And that's assuming no massive student loans, no big car payment, solid credit, stable W-2 income. So pause for a second. Ask yourself honestly, how many households do you know that clear $140K to $150K a year comfortably? That's not individual income, that's the household. According to the Census Bureau, that puts you well above the median American household. This is where the illusion breaks. A $500K home is marketed like a normal option. But financially, it's designed for a specific slice of earners. Now let's talk about who actually fits that slice. First group, dual-income professional households. Two earners, both making $75K to $90K, engineers, nurses, corporate managers, government professionals with stability. Not flashy, not rich, but consistent. They don't feel wealthy, but on paper they qualify. Second group, equity recyclers. People selling a previous home they bought years ago. They didn't save $100K from scratch, appreciation did the heavy lifting. This group is invisible in affordability debates, but they're everywhere in the data. Third group, high earners with delayed lifestyle inflation. Tech, finance, healthcare specialists, people who lived below their means longer than average, no luxury cars, no giant vacations, just accumulation. Fourth group, and this one matters more than people admit, family-assisted buyers. Gifts, early inheritances, down payment help. The bank of mom and dad isn't a meme, it's a measurable force in the housing market. Economist Thomas Piketty has talked about this for years. Wealth transfers matter more than wages in asset ownership. Now notice who's missing from this list. Single buyers earning the median income. Young professionals with student debt. Families relying on one income. They're not irresponsible. They're just priced out by structure. And here's the psychological trap. Most people don't feel poor. They feel almost there. I just need a slightly better rate. I just need prices to cool. I just need one more raise. But the system moves faster than individual progress. While buyers wait, property taxes rise, insurance rises, maintenance costs rise, and wage growth struggles to keep pace. Now let's address the hype. You've probably heard someone say, once rates drop, affordability will come back. Maybe. But here's the catch. If rates drop meaningfully, demand floods back in. Prices don't fall, they stabilize or rise again. This is the paradox economists at the Federal Reserve openly discuss. Lower rates help buyers until they don't. Because the market adjusts. So affordability doesn't magically reset, it shifts who gets priority. And this brings us to the uncomfortable reveal. The housing market isn't optimized for first-time buyers. It's optimized for capital continuity. For existing owners, for institutions, for those already inside the system. That's not a conspiracy, that's incentive design. Zoning laws restrict supply. Local governments rely on property taxes. Banks prefer low-risk borrowers. Everyone involved benefits from higher prices, except the person trying to get in. And in 2026, a $500K house is the gate. Now zoom out for a moment. What does this mean long-term? It means homeownership increasingly depends on timing, inheritance, and geography. It means renting longer isn't a personal failure, it's a rational outcome. It means the middle class no longer guarantees access to assets that once defined it. And here's the quiet irony. The people most stressed about housing often aren't reckless spenders. They're careful, they're informed, they run the numbers. And the numbers tell them a story they don't like. So let me ask you something. If a $500,000 house requires a six-figure income, substantial savings, and near-perfect financial behavior, what happens when $500K becomes the new floor? And another question. If this is affordability with stable rates, what does instability do? Because markets don't just move on spreadsheets, they move through human psychology. Fear, FOMO, relief, regret. The same forces that pushed prices up can freeze them or break them. And that's where the story remains unfinished. Not because no one knows what's coming, but because the outcome depends on who adapts and who waits for a past that isn't coming back. So when you hear someone say $500K is that bad anymore, listen closely. They might be right, but only for a shrinking group of people. And the real question for 2026 isn't whether you want the house. It's whether the system recognizes you as someone who's allowed to buy it. And if it does, what will you do next?